Good afternoon. This panel is about priorities and challenges for fiscal policy in Europe. It is the appropriate moment to have this discussion, as the new rule that has been in place for less than 2 years are already under test. One of these tests comes from the need to enhance Europe's defense capabilities and raising its strategic autonomy. We need to find financial resources at times of still high level of geoeconomic uncertainty and differential performances among countries in the euro area. On the positive side, we can list the fact that the EU economy performed better than expected, and the inflation is basically under control. Against this background, it would be interesting to hear from our panelists about the priorities and challenges that they see at the national European level with regard to fiscal policies. In particular, they might want to tell us, for example, how they see their opinion on three big topics. One is the trajectory of fiscal deficit and debts and related challenges among the euro area states. Another topic could be the interaction of monetary and fiscal policy and the implication for the macroeconomic policy mix. And lastly, whether they see any EU initiative in the area of fiscal policies that address the still high level of uncertainty and geoeconomic fragmentation. I mentioned several times our panelists, but I have not introduced them yet. So let me do that in a brief way, since I am sure you all know them. So first we have Laurence Boone. She is the head of Santander Corporate and Investment Banking in France. She has held prominent positions in international organizations, government and fiscal institutions, and she is recognized for her expertise in European economic policies, fiscal and monetary strategies, and geopolitical economic challenges. Next to her, you have recognized Marco Buti. Marco holds the Tommaso Padoa-Schioppa Chair at the Robert Schuman Center of the European University Institute. Before joining the Institute, Marco was Chief of Staff of Commissioner Gentiloni between 2008 and 2019. Marco was Director General of Economic and Financial Affairs at the European Commission. Close to him, we have Moritz Schularick. He is the president of the Kiel Institute for the World Economy and professor of economics at Sciences Po. He is an elected member of the Academy of Science in Berlin and a research professor at the New York University. Moritz has published extensively in top economics journal in the field of international economics, monetary and fiscal policies, economic theory, and international finance. Lastly, we have Rodrigo Valdés. He recently assumed the role of Director of General Fiscal Affairs Department at the IMF. Prior to this, he was a Director of Western Hemisphere Department. Early in his career, he was a professor of economics in the School of Government at the Catholic University of Chile and held the position of Chile's Minister of Finance from 2015 to 2017. Rodrigo also has an impressive experience in the public and in private sector, and he is highly respected as an academic. Before I give him the floor to them, let me recall the rule of the game. In a first round, I will ask our panelists to address the same question. That is, what is your view on the role, on the title of this panel, that is Priorities and Challenges of Fiscal Policy in Europe, I kindly ask them to do that in 7 minutes. In a second round, I will pose to them specific questions to each of them, and again, I will ask to them to do it in 7 minutes. This should allow us, after these 2 rounds, we should still have 30 minutes for Q&A from the audience. So without further ado, let me invite the panelists to take the floor, and we can do in the same order as I did the presentation. So Laurence, the floor is yours.
Thank you, and thanks very much for the invitation for what I think is the most important question in economic policy at the moment. So I am not going to question your title or the title of the conference. I told them up a minute, we have growth. It's projected to accelerate in 2026. But we have many, many urgent priorities, and defense, I think, come on top of our agenda. And when we discuss fiscal policy, I think it's super, super important that we do that within the context of what we need to do for defense and security in Europe. And we tend to think it's a medium-term challenge, but I don't think it is one. It is an immediate challenge, and we have to answer that question now. And it's not just me, obviously, it's EU leaders, it's NATO, it's the European Commission, and even the ECB has stressed this. So what's the size of the challenge? As you know, at the latest NATO summit, EU member countries have agreed to increase their defense spending massively because they are targeting 5% of GDP in the medium term, so that 3.5% for core defense and 1.5% for broader security like infrastructure, but also to address hybrid threats. And these are already here. We can see GPS jamming in the Baltic country, in the Nordic country. I think one very striking thing is it's about 85% of the flight in this area which have been jammed recently. Okay, so this size, 5%, means that demand on fiscal policy will be massive. If I just take the example of Poland and the Baltic states, Estonia, Latvia, and Lithuania, spending on this scale, it could absorb up to 15% of their tax revenues based on outcome for the recent years. It's not my number, it's an OECD number. And I don't, yeah. Given the, sorry, I'm just gonna, it's my fault if I go backward. Can I go backward? Yeah. This is just showing two things. The bottom panel, the blue square that you see is defense spending across these Western countries in 1962. The orange part is the same thing in 2022. And you can see how far down we've come and how much we need to go up. And then the top chart is showing R&D spending in defense. The big blue thing is the US. And I just want you to have this magnitude in mind. Okay, so given the scale of the ambition, because basically we want to go back to the blue square, the question of financing will be questioned. There are many countries who are addressing this question by planning to borrow more, and at least in the near term, because they need to ramp up very quickly. And if we take the example of Sweden and Germany, they have loosened their fiscal rule to make room for higher defense spending. But a much larger group of EU countries, they're using the national escape clause in EU fiscal rules to add 1.5% of GDP more on defense up to 2028, compared with their levels in 2021. Okay. That sounds like a plan, but I think the reality is a lot more challenging than this, because for many of these EU countries who are now promising to raise fast and massively defense spending, the debt and the tax burden are already super high. And they are already grappling with the cost from changing demographics and from energy investment. Now, if we look at economic theory, this does not really need to be painful. I insist in theory. In theory, then, higher defense spending will have a positive multiplier if we direct it at European production. Because it's like any spending, defense spending, when they rely mainly on local production, they can boost public sector investment, they can boost domestic private sector activity and jobs, and they have relatively high multipliers. And Europe has a large basis of defense industries. We don't know that very often, but Europe is producing military equipment as much as the US. The difference is we're exporting about half of it. The second point in theory still is that higher innovation spending for defense will or should also raise European productivity, which is why I also wanted to show this chart on US R&D defense spending. Because when we look at the US, we have a perfect example of how technological innovation from the defense industry is spilling over into other sectors. And the advantage for Europeans, if they were investing in their own R&D in defense, is that it would be their own European technology, and it would ensure we can keep control of this technology. And that relates to all the sovereignty talk that we have now. But that is the theory. And if we look in reality, 2028 is tomorrow, or rather, if we want to spend that much, it's yesterday. So the real challenge, I think, to fiscal and monetary policy is how the EU can ramp up defense production and purchase without triggering bottlenecks, which in turn would generate inflation, which in turn would lead to higher interest rates and therefore to less growth. Especially in the context where probably the ECB is more or less at a neutral stance. And growth is expected to accelerate in 2026, so we can perhaps challenge this, but I don't think you're going to tell us today, at least, that you will lower interest rates in the near future. Okay, so I can think about two possible directions. That will be my last part, and they're not mutually exclusive. The first one is obviously coordination. Coordination will be key for ensuring that we have critical mass and, more than anything, interoperability. At the moment, a military person driving a German tank does not have the capacity to drive tomorrow a French one, and they don't even use the same fuel, which is a problem when you're on a military field. So coordination is key for avoiding duplication. Coordination is also key for enhancing visibility for the industry. Because as we know, defense is not an industry like any other. If you produce a nice missile, and your government is not buying it, you cannot put an ad saying, look at my missile, it's pink, it works really well, does someone else want to buy it? So you have one client, which makes things a bit more difficult. Industry needs a plan to be able to ramp up production. So if European countries can plan sourcing defense equipment, input, or services from each other, they will give visibility to suppliers and they will direct the fiscal spending locally. In that case, then regional multipliers for increased defense spending should exceed those in individual European countries. And there are some recent papers that suggest this, for example, by the European Commission or by Iletsky, who say that a collective 1.5% of GDP lift in military spending could boost Europe-wide GDP by between 0.5 and 1.5%. But conversely, and I think it's super important to keep that in mind, if we increase military spending without coordination, without visibility to enhance production capacity, then very likely the result will be some combination, not very nice combination, of higher import, higher inflation, higher interest rates, and ultimately reduced private sector activity. So that's one route, coordination, to avoid this. The second one, I think, lies, with monetary policy. We know inflation is roughly at target, which means that monetary policy has fulfilled its primary objective. Congratulations. Therefore, monetary policy can start looking for its secondary policy objectives, which is that of supporting the other policies of the EU. What are the other policies of the EU today? It's investment in defense. So if you look at monetary policy, you think that we're more or less neutral. I'm sure you don't have an exact, as between econometricians, we know it's not an exact, precise estimate of what the neutral rate could be, but a more or less large range of estimates. There's probably a possibility of keeping rates closer to the lower bound of the range of equilibrium interest rate, so as to support the secondary objective of the ECB, the other EU policy. So with that, I think I have exhausted my 7 minutes now. So let me just conclude. I think your title needs some amendment. We need to add under the constraints of our defense commitment. And the top of our concern, I think, should be how policies can help ramp up defense demand without generating tensions on supply or import leakages. Thank you.
Thank you, Laurence. Let me give the floor to Marco.
Okay, thank you very much. Thanks for the invitation. What I'm going to say echoes a bit what Laurence just said from a different perspective. I will deal with two questions. One actually echoes quite a bit of things that we said this morning in the various papers. The other one not, but I find it's an important dimension that we need to discuss and link to Laurence's point. As discussed in the first and also I think in the third paper this morning, I mean, public debt sustainability has not gone away. And actually, if you look at what has happened lately and what is going to happen in the next years, I think this risks to come back with a vengeance. So to look at that, they have gone back to the prehistory. So Olivier Blanchard, a paper in 1985, where he introduced the concept of maximum sustainable level of public debt, which is the expression that you have in red there, so DHAT, which is basically the maximum politically feasible primary surplus, so as star minus the long-term interest rate growth rate differential. So this is the concept that Blanchard puts forward. Now think about the next 5 years. I take this as the medium-term objective, the medium-term perspective and dimension. It seems to me that all these variables actually go in a direction of making it tougher to deal with public debt sustainability. Okay, take the first one, the maximum politically feasible surplus. I think Laurence was very clear. I mean, this is going to be reduced in the future. Rise in defense spending, but also more broadly, let's say the Draghi report, so competitiveness and investment. Healthcare, you can add other demographic-related spending. So this is going to go down, and so in the wrong direction. You have the average interest rates on public debt. So here, the equilibrium real interest rate, we don't really know in the long term. But if you think about the average cost of debt in the next 5 years, when we have to renew, to roll over the debt that we incurred during the period of ultra low interest rates, is likely that the average cost of debt is going to go up. And on the growth rate, so take potential growth rate, I think here demography is not going to help. I mean, if you think about it, over the past 10 years, not the future, past 10 years, median age has increased by over 2 years. So we are already in the demographic winter big time. Now, put a question mark beside AI, maybe we are surprised there by the miracles of UI on productivity. I think at least in terms of perspective and prudence from a policy-making perspective, I think I would not bet on an immediate surge in productivity, which would, in a sense, solve all the problems via the denominator. So this implies that you put all together, the maximum sustainable level of debt is actually going down. So it means that if you pass the bar there is no way to bring the debt down through the standard measures. So then you will have to work either directly on debt, not very pleasant, or you go towards some form of financial repression, or you invest, and much more than we can do now, and that's the part that is more forthcoming on growth. But there is no way, and here I link also to the discussion we had a bit this morning on the first paper, there is no way to solve everything via the denominator. So it means that in a number of countries, the going to acceptable, more adequate level of primary surplus, I think, is a must. If I take the past 25 years, France had a primary surplus, slight primary surplus, 3 years out of 25. Italy, 21 years, Germany, 14 years. Now, careful about this, because the problems here with the health of public finances are at the two extremes. France is not able to generate a minimum level of primary surplus, and we see all the discussions right now. Italy, in a sense, you had to generate large and persistent primary surplus precisely because the denominator did not help at all. So the problems with the health of public finances and sustainability of public debt are the two ends of the distribution. Now, the second point is this one. Quickly here, because I'm ending my time. Okay, we discussed in Europe a lot about application of the rules. Maybe we come back to that in the second round. Horizontal national coordination. I think the key issue in the future, or a key issue in the future, is vertical policy coordination between what you do at the national level and what you do at the European level. And I think, again, here, the reference to defense is a must. What you can see in this table here, I have tried to reconstruct the events through these two dimensions, central fiscal capacity and national fiscal constraints, since the beginning of the global financial crisis. So we had the two combinations. So we had, during the global financial crisis and during the sovereign debt crisis, we didn't have a central fiscal capacity of any sort, and we had national fiscal constraints essentially imposed by the markets on vulnerable countries. We moved down during the sovereign debt crisis and the aftermath essentially till COVID, where we had a combination no. So we relaxed the rules, the market pressure after whatever it is went down, and we still did not have a central fiscal capacity. With pandemic, we moved across, we set up next generation EU, so one-off large central fiscal capacity, and we relaxed the rules of the Stability Pact, so next generation EU and the general escape clause at the time. Now, the big question mark, that's why the arrow is dotted there, is whether and what are the conditions to move into the final quadrant. We are still not there, and this is the year of geopolitical fragmentation. And what are the conditions in order to move there? And I think not a sufficient condition, but definitely, in my view, a necessary condition is that we apply the rules that we have in a serious manner, and that may, with time, create the trust in order to remove the obstacles at the central level. And it may well be that defense may be the trigger in order to move there. Thank you.
Thank you, Marco. Moritz, the floor is your turn.
Great. Well, first of all, thanks for having me here. It's a great pleasure. And let me see if I can make up some time. So I want to essentially talk about three points: the good, the bad, and the ugly. The good is the security situation has changed, and we've reacted. Europe has reacted. We are borrowing now, and that borrowing makes sense economically. We're smoothing a shock. And it also makes sense to invest upfront, to front load the investment, because there's a deterrence aspect, obviously, of what we're doing. So I think generally speaking, what we've done in Germany, getting rid of the debt brake for defense, using the fiscal space where it is possible to invest in defense makes a lot of sense. The question, coming to sort of the bad, is if you look at the question how to spend it. Laurence mentioned it. I think it's quite clear what you want to do, and it's also quite clear what's not happening sufficiently. But hold your breath, I'm coming to the ugly still. So the bad is you want to jointly procure, it's not happening. You want to scale up production to increase production capacities and scale up to lower unit cost and realize savings. It's not happening. I can tell you, 4 years into the famous Santander, most big German defense companies are still working single shifts, 5 work days, not 3 shifts and 7 work days. We're still at artisanal production rates when we look at European defense industry. So almost nothing has happened on that front. And things that come very naturally to someone who speaks economic language, like not procuring quantities of missiles, tanks, whatever, drones, but going for capacity contracts so that we acquire the production capacity by 2028 to produce a given number of defense equipment we need, is like speaking, a Martian language to most defense ministries. The procurement processes and the economic thinking going into that huge expand of defense spending is widely, economic thinking is widely absent. So then there's another question that Laurence also talked about, and I'm not going to repeat it because it was excellent, but I think it's clear we want to make as much of the stuff at home. I think it's clear that we need to expand capacity, and so otherwise the spending just goes into higher prices and does not have the economic effects we would like to have. And I think very importantly is the role of R&D. There's a lovely, great paper coming out in the AR right now, Paulo Storico and co-authors, about the long-run productivity effects, and that I think where the defense agenda connects very directly to the Draghi agenda and the European agenda in terms of productivity deficits and technological deficits. If you think about what Europe needs over the next decade to live in security, and let me stress this, we're doing this for security reasons, not to stimulate the economy or upgrade our economy, but if you think about what we need to live in security over the next decade, you talk about autonomous systems, you talk about AI, you talk about space capabilities, you talk about satellite constellations, you talk about advanced software, you talk about hypersonic technologies. And if you be honest, these are all the areas in which Europe has fallen behind the US, behind China, in the civil space. So taking all these investments and using it to upgrade our economic potential, our technological potential, is a great opportunity, and I think it's underused. I'm still coming to the ugly, don't worry. Actually, we have a proposal with Elaine Ray and Philip Hildebrand, you might have seen, where we say like Europe should come together, issue 1% of GDP in defense bonds for 10 years, so with 10% of GDP of sort of supranational debt that allows us to finance the next generation. Because there is also a story that you all know that Europe is backward looking a lot when it comes to defense investments. We're right now procuring a lot of the stuff that our militaries were not allowed to have in the last 20 years, not necessarily the stuff we need in the next 20 years. So we're kind of failing on that technology frontier. If we do that, if we invest in additional capacity, if we do it at home, and if we invest in R&D, and Laurence mentioned it, the US spends 15% of its defense budget on R&D. I know the German figure is 1%, the French figure is 2%, of a much smaller overall budget. We still have way to go, so we need to make sure, I think, that a lot of this goes into high tech and the technology of the future. If you do that, and I just give you just a rough idea how big a game changer this could be. The German defense budget is roughly going to be 150 billion for the next 5 to 10 years. If you assume a 10% R&D share, not the 1% we have right now, we're talking about 15 billion R&D spending coming out of the defense budget alone in Germany. That is the entire budget of the German Federal Research Ministry, or approximately 7 times the annual budget of the Max Planck Society, which are the guys with the fusion reactors, the astrophysics, who win Nobel Prizes. So the numbers of what could go towards R&D and next generation technologies are quite, are really mind-boggling. So the ugly one, I'll be really short, I promise to not talk too long, is that there isn't really a plan. Right now we are on track, and I really want to say this drastically because it upsets me to some extent. Right now we're on track in Europe to spend roughly €1 trillion on defense over the next 5 years, and at the end of this we will be as dependent on the Americans as before. And that's largely because there isn't a plan. There isn't a willingness to go for a European autonomy. There's all kinds of problems in bringing the European countries together and actually doing these things together. But that's clearly not, from a resilience and geo-economic point of view, I think the outcome that we as Europeans want to see. Let me maybe leave it here and look forward to the discussion. Please.
Thank you. Rodrigo.
Okay, thank you first for organizing this. We had Vítor Gaspar before in FID, and he had a very deep engagement with Europe. He knew about Europe a lot. I don't pretend to become Vítor. What I can say, though, is that FID will continue trying to have a very good relationship with Europe. I want to talk about 3 specific things. One is how we see challenges in Europe in comparison to other groups of countries in the world. Then I want to discuss a bit about fiscal space. I see a lot in the, now it's a fiscal room, headroom. There are different ways to discuss this, but a lot in the press. And a final word on the fiscal rule of Europe. My general point will be basically that, unfortunately, Europe, if you compare to other regions, although it has in the very short run dynamics that are not super complicated, many countries with low debt ratios, a few with higher, perhaps only France with that dynamics because they haven't sorted out the short run. Despite that, despite being in an initial photograph not too bad, if you go more medium run, you see several shocks that are affecting other countries that are worse for Europe. There are shocks that are, I would say, the same for everybody. Before, Marco mentioned high interest rates, for example. Everywhere we have this problem that interest rate this decade will be very different from interest rate the decade previous COVID, and we are marking up the debt right now. But Europe is not that different there. We have the issue of generalized shocks, no? If you see the history of countries everywhere, people, authorities, even the fund, we tend to be over-optimistic, and we have shocks to one side. I will come back to that in the second round if I have time. But there are other shocks that really are more complicated for Europe. Let me start from defense. I think this has been very clear in the previous presentations. I just want to mention that the peace dividend of the last few decades was not even distributed at the end. And the reversion of that will not be there, no, and is more costly here. The second is demographics. Everywhere, demographics is an issue. But first, the demographic shock in itself is worse here. Only Japan is worse. Mm-hmm. But probably in the region, we have the worst combination of demographics and a social contract or entitlements that makes this much more complicated. Our colleagues from the European Department put together their regional economic outlook a few months back. And they calculate that about 15 years from now, Europe will spend about 3 percentage points additionally just for this. And later, numbers that really dwarf the defense discussion. And third is productivity developments. From afar, we see a lot of things happening in the US, in China, around AI, about technology more generally. And it's not happening in Europe. So really, really, that could be even more problematic, because if the world lifts potential growth, interest rates around the world may be higher. And that will percolate here too. So going back now to the regional outlook that I mentioned, there is a cry there saying, look, you need to do things for growth beyond defense. That's urgent for the region. For itself and because of the fiscal. In our fiscal monitor, in the last one, we had a very good chapter, I think, in charge, so I can say that it was good, about how to spend better. And the fiscal multipliers, for example, of reallocation between current spending to more infrastructure of different sorts, have a very, even negative multiplier for the first year, second year. But 10, 15 years down, multipliers are very large. So, and there's also the story of spending more efficiency, with more intelligence at the end. Okay, that's the challenge. So the challenge is pretty large. A few words on fiscal space now. I think this discussion of fiscal space, I think goes back and forth and is not very organized. Let me try to give a bit of organization. I think we need to think of for what is the fiscal space. And this one that is basically to use it to spend more in investment, a bit like Germany today. Now, in that metric, not many other countries, large countries in the region have that space. That's very clear. But that's not that complicated if we recognize, and let me go back to our colleagues from the European Department, there are very powerful lifts to move growth in the region. Completing the capital markets union, labor mobility, the electricity grid and the market, and many other ideas that came here. So maybe you don't need the fiscal space for that. There's another discussion completely different. There is fiscal space for embarking in counter-cyclical policies in case of things go wrong for some crisis. I think that may happen eventually, and I'm not that worried about that fiscal space. That fiscal space sort of exists. And perhaps more importantly, if anything, the crisis, the last two crises, first made that central banks now pretty much know how to operate at the zero lower bound. So the rationale for fiscal activism is lower than in the past. And the second point here is that I think the exposed, at least with inflation that we saw after COVID, probably want to calibrate better the macro reaction to future shocks too. No, perhaps a bit less activist. Final point about this question about fiscal space. Let me put it in a completely different metric now. That is, how much debt should Europe have? And here there are good stories. In the morning we listened to this paper that the problem with distortionary taxes makes a case for lower debt. There is also the story of private sector crowding out. There are, other reasons not to press too much. But let me give you one more. If it's true that we will have this issue of declining population in 30, 40, 50 years, and we have to start thinking about that, that changes completely the paradigm that we have, that leaving some debt for the future was sort of just and was part of the intergenerational contract. If this is the reality, the new reality, we have to rethink on that. So bottom line, if anything, less debt seems to be appropriate. Final point of the three, one word about rules. I think and this was said already, it's time to apply the rules. When I met with my team before coming here, I didn't know much about the fiscal rule. So I said, oh, that's a bit complicated, the rule. No, we support the rule. We say, we are with the rule. So really, from our perspective, what is critical is that the rules are respected. If one thing are complex with rule is that you have rules and you redo the rules and you don't apply the rules for too long. So it's critical to do it.
Thank you. This first round of intervention were kind of
lack of discipline.
Well, no, I mean, beyond that, you said very important things. That's why I allow you to go on. So I hope a little bit more discipline, talking about constraining the spending and the debt, so in the second round. So, Laurence, you mentioned before, you were already hinting to this issue of the policy, the right policy mix. You said that, you already said something, it will depend on the coordination and the policy environment. Can you articulate a little bit on that?
Okay, I was planning to skip the first question.
Oh, okay.
And no, because I mean, truly, I think we've been talking a lot about the level of debt, the growth of debt, and defense and coordination. So one thing I think which is important now is growth, right? Because we focus a lot on the numerator, but we need to think of the denominator. One word on the policy mix stance. I think we all agree growth has potential. Potential is low. If we think monetary policy is roughly neutral, but has some room on the bottom of the range that I'll keep aside, it will help growth. Now the true thing is what can be the game changer in growth. And here I make 3 points, but unlike what Moritz was saying, they won't be the good, the bad, and the ugly. Also, I start with a good one, but not the others. The first one is, I mean, this was very depressing, right? Because what we're saying is we don't have growth, we have high debt, we have to spend on defense, and we don't have a plan, and we'll do it in an uncoordinated way as usual, and this will create inflation, okay? So let me get back to something a bit more uplifting. First thing is, I think we need to remember that we're a Team Europe, and it's a very, very strong one. When in previous function, when I was going to the US, Rodrigo, I was also always telling my team, you know, we need a speech that looks like a US one. So let me do it. We're 440 million European citizens with an income per head of roughly 40,000 euro. That makes us one of the, if not the richest region in the world. We are the world's leading region for inward direct investment, and we are the first leading region for outward direct investment, okay? No other region, not China, not the US. We have possibly the largest market, which makes us extremely attractive to both the US and China. And if you look at it, this is the logic behind the direction of US policy. They want to access even more our market. And it's also the logic behind Chinese policy. They want to offload their excess production here because they are all these consumers. So we have this single market, and we're a pretty open region abiding by rules. Let's leverage on this and extend and diversify our trade and investment agreement with as many regions of the world as possible, as many for diversification and lowering risk. And you know, look at Latin America, look at South America. They have regulations that are, I mean, I don't need to tell that to Rodrigo, but they have regulation, culture, shared values that are very close to us. We are not using this, case in point, Mercosur. We could do a lot better and quicker, as Marco was saying, than this. Second thing is, I think, tech. And both Moritz, everyone, by the way, talked about AI. Again, we produce as many scientists as the US. The only trouble is we export a good share of them to the US. We create startup, and we don't have an issue of creating startup, but they scale up in the US. I think it was Mario Draghi who said that between 2008 and 2021, 147 unicorns in Europe. That's a lot. 40 of them moved abroad, and most of them to the US. So the result is American tech companies today, they account for more than 75% of global market cap in the tech sector. Asia for around 18%, and we, Europe, a small 7%. And when we talk about productivity growth, the gap, because of tech, explain all of the gap with the US. Today, the Commission released a super important paper about financial market integration. And one of the key enablers for the startup to grow in Europe and not to move to the US is this. It's the saving and investment union, and it's the possibility of channeling this private saving that we have to digital investment, which brings me to my last point. I'll be much faster than first time. But what I wanted to say here is also, I think, important. We may have an issue on the public finance side, but we don't have an issue on the private finance side. In fact, if my source is right, and it's Christian Noyer, it must be, Europe household financial savings amount to more than 35 trillion. 35 trillion. With one of the highest saving rates in the world, another record for the Europe, more than 13%, okay? But as he notes, we're very poorly allocating these savings. First, we export part of them to purchase foreign debt securities. And second, we import equity financing, which is essential for the development of our company. 1 billion euro leaves the euro area every day in search of higher returns. 1 billion. It's a lot. Why? Because our savings, they are too often liquid, which is a big difference with the US, for example, and they're guaranteed, about half of them, which is huge. And obviously, when you have liquid and guaranteed, that means you're not investing into risky investments, right? So you're not financing businesses, whether they're small, large, young, or old, you're not doing it. Okay, so we need to change that. First, risk appetite. That's culture, but I think we have to assimilate this. And the other is a level playing field. And here I'll make 3 very quick points, and that will be the last one. The EU has more than 193 texts, nearly 9,000 pages of prudential regulation. This is 3 times more than the US or Canada to direct and protect savings. Perhaps we can have a look at those and see what we can simplify or eliminate. And I'm not talking about race to the bottom, just simplification and clarity. The second thing is the capital of EU banks has tripled. It was 2 billion in 2008. 2 trillion. It's now 6 trillion. Okay, if 1 billion of capital, it's about 16 billion in lending to SMEs. Okay, I think we can think about this. And that's it. I'm going to conclude. We have the resources, financial, human. They exist. We need to keep them home. We have a plan, the Draghi report, the Letta report, the Noyer report. We have a crisis. We have the 3 ingredients necessary for a revolution. Thank you.
Maybe we need a little bit of political will. Hopefully,
Yeah.
Marco. We have 11 minutes and 3 interventions.
For 3 interventions, okay. No, okay.
I was 3 minutes.
Are there new rules working?
Okay, the new rules, they have a chance to work, but there is a big question mark. Okay, first of all, the Stability Pact is not sexy any longer. So if you
has it ever been?
Was it ever?
It has been in terms of generating political. Now I think nobody wants to talk about that, and we are under the lump sum of political capital. So we are spending that on other much more pressing issues. So the fiscal rules, in a sense, they are put a bit on the side. Now. Okay, the rules were adopted, entered into force in spring 2024. I think the member states, they played the game in the first batch of fiscal structural plans. I think they adopted the spirit. They had plans for net expenditure which are consistent with long-run sustainability. So I think the first shot ex ante was okay. Then what we had the NEC, so National Escape Clause, which is not very nice to have when you are just applying the new set of rules. 16 member states applied for that. And so de facto we entered into a regime in which there was, if you like, half suspension of the rules. I mean, the National Escape Clause allows for 4 years 1.5% of GDP additional spending for defense. So in a sense, we entered a bit into a limbo. Again, there was an assessment last week or 2 weeks ago of in the autumn package of the Commission on the implementation of the rules. I think overall member states are still behaving, but clearly the pressure is much lower. Now, the National Escape Clause, I think, is to accommodate defense spending, and together with the loans safe, 150 billion, in a sense, try to push member states in the right direction on the defense spending. But the combination of the two is still very much a decentralized approach. So we are not moving into my last quadrant there, and I think there is an issue here also, thinking about what Moritz emphasized before. I think the more you are, this is, I put it on the table for discussion, I think the more you are in a decentralized mode, the worse the quality of defense spending will be. So I think the reallocation towards the good spending, which has also an impact on total factor productivity, etc., I think is much more likely if you have a more centralized approach. So I think this is, seems to me, yet another reason to have some, not only coordinated, but some element of centralization. And I can see also in the past, once we have tried to constrain member states simply by coordinating, we didn't get there. I mean, I talk about with my previous hat. So some element of centralized financing is needed. The final point is that, are we going to reform the rules yet again? Okay, difficult to tell. As I said, the political capital to spend into never-ending discussions on this is not there right now. The current rules are not compatible with the very welcome approach by Germany. I think what has been decided on the infrastructure fund, and in particular on the exemption of above 1% of GDP of defense spending, is not compatible with the rules as they have been reformed. In principle, the best thing would be to do some surgical changes. For instance, getting rid of what Germany is a curse for the fiscal rules. It was 20 years ago, it was the same with Schröder government. Now it is for much better reasons. But again, I mean, we are running against these numerical benchmarks which were not there in the initial approach of the Commission, which have been imposed by Germany, and now they come back with a vengeance because they constrain what we can do and what, in particular, Germany can do. I think the worst possible thing could be that, in a sense, we try to accommodate Germany by playing a bit with the denominator. So expecting miracles in terms of impact of this additional spending on growth, and so miraculously the denominator accommodates everything. I think that is not going to happen. But if you ask me, where would you put the money in the future on either surgical reforms or some dodgy accommodation? Probably I would go for the second.
Okay. So again, the task becomes even more difficult because we have 5 minutes to intervention, so let me go straight. Do you have any specific recommendation, Moritz, for how we should go ahead?
So I don't think it's realistic to ask of governments with really pressing national security concerns to be overly preoccupied with fiscal rules. It hasn't happened in history and it will not happen this time. It's too pressing for that. Second, I agree with Marco. The decision has now been made to rearm on a national basis, which will cost us dearly and will prevent a lot of the good things that could happen from emerging. The reason is very simple. Every European country is planning within the NATO capability targets. And the NATO capability targets also assume that the Americans are going to be there whenever we need them. That prevents us from replacing the American strategic enablers, which, by the way, are also the juicy bits when it comes to technology, the space, the communication, the satellite and rocket technologies that we would like to have. So we're a little bit in a trap because the defense ministries who are in charge of the planning and have all the money right now are thinking in the context of NATO for good reasons, but the thinking in terms of NATO prevents us from going European, and no one so far has kind of squared that circle. Last word is, and this is then less than 2 minutes, is when we presented, and I think that summarizes the European situation quite well. It's a coordination problem. When we presented that idea of financing the next generation tech defense enablers, and keep in mind there's one area where Europe right now is the global hotspot of technology, the only area probably where we're leading, and it's drone technology. And when we proposed to go in all European on financing these next generation defense things, the answer at the Franco-German Ministerial Council in the summer, the answer from the French was, we don't like common assets, and the answer from the Germans was, we don't like common liabilities. Yeah. And that was it.
Okay. Well, maybe, the political will is endogenous to this discussion, but this is for another thing. Rodrigo, I want to ask you, don't you see a little bit of asymmetry around the world? I mean, there are other jurisdictions that are not in a better position than us, but they don't seem to be so concerned. So from your standpoint of view, how would you compare EU to other jurisdictions, which I'm not going to mention?
Well, 245, this reminds me always, because I'm always the last in panels, about the problem with pay-as-you-go pension systems, that the last generation has to pay this time. Okay, so look, can I get back the graphs? Let me talk very quickly about the US and China, okay? Because here we have discussed a lot about Europe. The next one, an extra one, please. So I showed you before the same chart, but with Europe. And believe me that the pace of the United States and China with respect to the rest of the world is really amazing how it's going up. If you can go up, please, in the slides. Another one. One more, yeah. That's the debt ratio in the US. Probably known for all of you, no? But it's really, really record and super complex. So what's going on there? There are three characteristics, I think. One is that debt is growing much faster than Europe. Second, for some reason, both markets and policymakers are not that worried. If you have a discussion like this one, in these other countries, they will be very different. So the level of recognition of the problem is very different. Why is that? And this is my third problem. Third point. In both cases, there is some narrative that they will get out of this without fiscal efforts. In the US, basically, it's growth. Of course, it's a big bet. But if you look at actual productivity growth in the last 2.5 years, stripping out all the COVID recovery, it's amazing. It's going very, very fast. So you cannot say, no, this will not happen. It's not obvious the case. Of course, this is too steep for to be solved only by that. But that's, I think there's a narrative there. In China, I was in China a couple of weeks ago discussing with officials, but more other people, no? NGOs type of. And they have a narrative of assets behind the debt that is pretty impressive. They have from treasury reserves to complexes of industries. No? So in both cases, I think there is a narrative that is pretty different. Let me just finish one thing. At the fund, we say that this trajectory, debt, to be very specific, is sustainable. And you will see that in the past Article 4, in the future Article 4. So the question is how you say that this is sustainable. Yeah, actually sustainable in our own definitions. What is not sustainable really is current fiscal policy. But the US has several things that they can do to bend this curve. And that's why we say it's sustainable, and we give a list of things. That list exists in previous Article 4s. In the new one that is forthcoming soon, there will be another list of things that could produce this stabilization. One last thing that I want to mention, Europe versus China and the US. I think also one perceives that in Europe there is this need to invest more driven by the government. In the other cases, really the US is private investment. Investment in historical comparison is pretty high. In nominal terms, super high in ratios. In real terms, in ratios, normal. And if anything in China, we need less investment. So that also produces a tension in the discussion around fiscal that is interesting. Thank you.
Thank you. I mean, we...
Almost.
Yeah, no, you did a great job. I'm sorry. We run out of time, so I don't have time to open the floor. Let me just conclude this by saying that despite the gloomy atmosphere, I think that there is some point in what
we have.
Oh, we have. Oh, okay. We were allowed 30 minutes more. So sorry. I'm sorry. So let's open the floor. Klaus.
Yeah, thank you. It was a fascinating panel. What a fascinating panel. And I want to focus on defense. And my question is, say, very blunt. So far, the EU failed to do anything reasonable. Ukraine is still far away from joining the EU. There is no common defense policy. The only thing which you could think of is, as Luis Garicano says, the EU concentrates on economics, on the single market, where they have a main responsibility, and they have partly failed. And a new structure is built, perhaps as the NATO, all the NATO countries, which then would go alone when the US is finally out of the NATO, which may be the case already, we don't know. They're willing to go ahead. The EU has not managed to get Orban under control or kick him out from the voting rights. The EU has done so, I mean, we are in a war. And the EU has, I mean, the EU as the institution of the 27 has not managed to do anything really progressive. And it's not criticizing the people there. The mandate of the EU does not include hard elements of defense. We know that. And so why do we not say the EU concentrates on the economic elements, which they can do a lot, single market, which Draghi and Letta have said, and the willing go ahead with the UK, with Norway, possibly Canada, and build a very, very strong defense union, European, without Hungary and without countries who don't want to enter the NATO, which are 4 countries in the EU still not in the NATO. Imagine that. So we have failed in the EU, so let's create something new and let the EU concentrate on economics.
Yep. So let me get Jean-Francois and then we try to...
Yeah, thank you very much for the discussion. The end result, though, was a bit depressing. So essentially, you all seem to agree that we need a fiscal union, actually not to spend more, but to spend better, in particular on defense. The question is how to make it happen, in particular politically, as Piero said. Now, the question is, shouldn't we go back a little bit in history and see how it happened before? Because the French don't seem to like common assets, you said, Moritz, but that's how they won the First War with their allies. At the time, Jean Monnet, who then became, as we know, the founding father of the European project, he was in charge of working on inter-allied supplies. And for this, the allies at the time established a joint military command. So is the right sequence not to start with putting our defense in order and then following up with the fiscal means to do that efficiently?
So, I don't see any other requests. So who wants to try to answer to this question? I know that, we are, a few years ago we had all to turn ourselves into scientists dealing with the pandemic. Now we are all becoming experts on military stuff, but, that's the life of the economy. So do you guys want to try? Laurence, please.
I will answer some of your questions. It's actually super interesting. I agree with you. Defense is not in the EU treaty, which is why they address it through the industrial bias, as you know, angle. One thing, if you look at what's happening, and you mentioned Germany, UK, and eventually Norway, that is actually happening. Germany is helping the UK in the North Sea to protect the cable which are being watched over, threatened by some boats. That is in the public domain. They are doing this in Scotland as well. France and the UK have re-signed or strengthened the Lancaster Treaty to be able to work together. So I think I agree with you that if we want to avoid the ugly that Moritz mentioned, we have to look smaller and start with a group of countries, which, by the way, is what happened at the beginning after the Second World War. It was France and Germany, a steel and coal community. You can perfectly imagine something called the E3. There's a very good article in The Economist of last week by this. Take UK, France, Germany. The advantage is 3 countries with a strong defense industry. One is not in the EU, so it's opening the door to others like Norway, and they have common interest and have been discussing about defense. That's the first one. For protection within NATO, then 2 things. For the traditional industry, national interest will prevail because it's jobs. That's as basic as that. And also because France, as we all know, because they're not shy of promoting it, has the nuclear bomb the same as the UK, but to a different extent. So for the traditional industry, it will be very difficult, which is why I think that Moritz and his co-author paper is super interesting. Because if you look at new industry, we have no national interest to defend. We have to build together to go faster. And since there's no industry, there's no job at risk, so it's easier to progress, I think, that way. And just one last thing, if we were to proceed with an E3 group, then I think you can mix the director of armament in each defense industry with the head of the army, so in each country, the head of the army in the 3 countries, and put some experts with it, because we're talking about new technology, and you recreate something like DARPA, which will be super helpful. Last but not least, we still have some job to do for NATO countries to agree on this, because NATO is by nature, and sorry, I'm getting out of my pay grade here, but very US focused. Look at the number of EU countries who are still buying US weapons, no matter what at this stage. But E3, I think, good focus to start with.
Anyone else want to jump in? Moritz.
I mean, I happily offered 2 thoughts on this. I basically agree with Laurence, and both questions kind of went in the same direction. I think the European coordination will be a Team Europe approach that will be outside of the EU. It will be somehow intergovernmental, because everything else is I don't think, not realistic given the composition of the current EU members. So that's number one, and that I think we need to get done. Second problem is that the fiscal space is very heterogeneously distributed. Germany has a lot, and other countries not so much. And what's prevailing now is that logic, who pays calls the shots. Like, you know, if Germany spends most of that European incremental defense spend, a lot of that, the idea is a lot of that will go to Germany and not be used to build a common European defense base with joint procurement or dual sourcing, etc. I think that's something to do. The key. And you know, it's really the key roadblock is that that there's a big fear that by pursuing a European agenda, you will push the Americans out, which is what no one wants to do, at least not in the short run. Of course, it's a catch-22 because that prevents you from ever starting, and you just prolong the addiction to your less reliable American friends on the other side. So that's an issue, sort of a Gordian knot or whatever you want to call it, that can only be solved on the level. That's not for the defense ministers to do. You know, that is the job of President Macron and Chancellor Merz and others to decide. And unfortunately, so far, that hasn't happened.
Marco, please.
The problem is not Orban, not Fico, and not the fringe countries. The problem is at the heart of the traditional pro-European countries. Lack of leadership there. I mean, that's why coalition of the willing, I think, is going to be the way forward. But we have to be also a bit realistic of what we can achieve through that, because traditionally the coalition of the willing, the quintessential example is the euro. Was that the key countries, at least the 6 who were the founding members, would get together. You create a vanguard, and then the others would come forward. But here there is a problem of the heterogeneity of preferences within the core of the countries. So I'm not sure at all that Merz, Meloni, Macron, would actually agree on speedy progress towards defense union in a way that is effective. I mean, when we had, and the question here at the end of the day is a lot about leadership. You know, when we had the examples in the past, take the single market of the euro, but also more recently, what we did in the front of, to address the COVID with Next Generation EU, a bit by chance, we had at the time leaders with, let's put it like that, low discount rate. So in a sense, they had the long horizon in front of them. Take the examples of COVID. We had, Chancellor Merkel, who had decided not to contest the next election, so she could think about history, not Baden-Württemberg. Macron had 1.5 mandate in front of him, and Ursula von der Leyen had 5 years, potentially 10, as president of the Commission. So, in a sense, that was a long horizon, which helped to cross red lines. Now, there is no willingness to cross red lines. So I think the problem is a bit deeper than so coalition of the willing, yes, but the hurdles for that are going to be important to get together and to I'm attached to my fourth quadrant, so somehow we have to get into that. And Klaus, yes, I think we have to go through a period of let's say retooling, or concentrating on that. Why it's considering at the same time that if the complement of that is loosening state aid, the crown jewel, so the single market on economic, is going to be jeopardized. And so we cannot go through simply, okay, we go the national way and that is the solution, because we end up with a broken single market.
I don't think he meant national way.
No. I'm saying if we go in the direction of increasing, loosening state aid.
Rodrigo, do you want to weigh in this discussion?
Look, defense is not something that the IMF should say much, because we have 191 members and it's very complicated. But let me just say, we haven't touched the word climate in all the panel. So if you add defense, climate, the demographics part that I said before. The question that we always ask at the final is, how will the Europeans pay for all this? So I think it's in this discussion, it's almost impossible not to put on the table the social contract of Europe. It's very difficult to square the numbers otherwise. And one number that is very simple. Europe has about 50% of GDP of spending general government. The US has only 38. So you are starting from such a different position. In the morning, someone discussed this a bit and the interest, but was in another context. No, I think it's very important to that discussion. Otherwise, things will be very difficult to square. And it's a super tough discussion, of course. Challenges here, trade-offs are immense.
I mean, if I can come in, not to disagree with you, you're obviously right, but just the idea that Europe cannot afford this, just to frame the numbers. You know, if you think about European, if you include the UK, GDP of 20 trillion roughly, we spend 3.5% of GDP. We're talking about a defense budget of 700, 800 billion a year. That's actually twice as much as China. That's probably more than we need because we don't, that's close to it. So these are numbers that 3% spending on defense is nothing where I'd say this is impossible. And probably if we spend it right, and the problem is we will spend it inefficiently and we replicate and will not, my favorite example is Starlink. Europe doesn't have Starlink and it's crucial for everything that's now. You know how much Starlink has cost? Less than this additional train tunnel that we're currently planning between Munich East Station and Munich Central Station. Slightly above 10 billion. It's not so much about the money. And I think we have the money, and I wouldn't go onto all this doom because that's 700 or 800 billion is a defense budget. That's 6 times Russia. You have to do the PPP, etc. But this is more than Europe needs, and I think it's something we can afford.
Let me correct. I don't want to enter into defense, as I mentioned before, not our role, but I want to put the sort of the idea of it's not only defense, it's many other things. So you should not take your eye from the other fiscal dynamics that are happening.
Yeah.
And perhaps defense is not first order on this, but the rest is first order.
Well, the political discussion in Europe seems to me that is reminding us that there are many other dimensions, and that's why possibly this discussion about defense is so hard. But let me ask you one question. I don't know. Let's see if there are other questions from the audience. Otherwise, I will ask one question.
Look, maybe one last word on this. I think, because it clarified in my mind as well. I think Europe cannot afford to spend an additional 2% of GDP, what we're planning now, basically go from 1 and a little bit to 3.5, without generating growth from that. And I think that's our task as economists, is to make sure, at least as European economists who can be blunt about where they want to go, is to make sure that if we spend an additional 2% of GDP on this, it cannot be. It has to generate. We have to do things that Laurence proposed to get the economic positive effects of that.
So my question to all of you is the following. I'm going back to the previous slides by Marco, where he showed that the R minus G, right? Y. R minus Y at the denominator. So my question to you is, the productivity growth was so low in Europe in the last 25 years because we spent so little in defense. What do you think? If we had to spend more in defense, what would have been the rate growth of productivity? Because this sounds very much like the American story. That's my provocative.
It's not only defense. There's energy to start with. We pay 2 to 3 times the price of energy that the US is paying. That's a huge difference for any industry. And by the way, on data center and AI, we rely on data center. That is a huge impediment to the development, right? When you look at the rate of growth of data center in the US and artificial intelligence and what we're doing here, we have a lot to catch up. So I think, and this goes back, you can call it climate, we can call it energy, because at the end of the day in Europe, there's no fossil fuel. So it's about the same challenges. The second thing is, I think on the slide, you didn't want slide, but every one of us ended up having slides. So on the one I put, you can see the spending in R&D in the US versus the rest of the world.
That's what I see.
And the spillover is huge. I mean, Moritz mentioned Starlink. We have a Telstat. But you also have all the internet and many other things which were coming from the defense spending, and I think that's what he was alluding to, and that would obviously have raised productivity. We have a fantastic research, but they duplicate work, and they don't work together, and the ecosystem between the research and the business and the army is miles away. And the last thing I want to get back, and again, I mean, we look at defense spending, we help countries build up, produce, import and export. But it's the pillar. We shouldn't forget the other thing, and I think energy is key. But if we don't ensure the security of Europe, how are we going to do the rest of the policy changes that we need to do? If we don't ensure the security of people and the sense of security, how are we going to adjust our fiscal policy? How are we going to boost growth? The discussion between Moritz and Rodrigo reminded me of a speech that Merkel did at the OECD in 2014. Europe represents about 7% of the world population. That's little. It produces about 25% of the global GDP, which compared with 7% of the population is not that bad. But it's also contributing 50% of global social spending. So we may have some room for reallocation.
Can I add one? It's a very good question, the role of defense in trend growth. But let me just mention the relevance in the US of the capital market that exists there, and I think there's a lot of homework here to emulate that. Second, the culture of risk-taking that is clearly very developed. And finally, how they have been able to attract, in the last few decades, very good entrepreneurial capital there from schools. And so that's another source of development, well beyond defense, I think, that others need to emulate, I think.
Can I comment on the, Rodrigo reminded us before that it is not only defense. So the climate is an important dimension. Now, if we look to the future, a study by McKinsey of about a year ago looks at the 10 leading technologies, so enabling technologies, from the point of view of innovation, production, and diffusion. Europe, China, and the US. Europe is competitive on 2 out of the 10. On others, they're lagging behind, in certain cases, massively. The 2 are new materials, clean tech. Now, the issue is not only what is, and if I look at the dynamics, especially in the European Parliament here and now on the Green Deal, there is not only that it is forgotten, there is a massive pushback. And I think if we accommodate that kind of dynamics, I think we don't only have an issue of a moral issue vis-a-vis the next generation. I think we are going to lose also in terms of the competitiveness on the competitiveness agenda. If you look at clean tech, patents and co-patents of Europe, and there is a nice chapter in the latest investment report by the EIB on this. Europe is leading both the US and China, and also in terms of exports to the rest of the world. In this area here, I think it's doing extremely well. So the not connecting the dots and leaving aside certain things because of this, lump sum of political capital that you spend all in defense, I think is not the right approach. I mean, there was a nice chart by when the Commission presented the autumn package 10 days ago on increase in spending on defense and correlated with a distance from Moscow. Very strong correlation, you can understand. So the issue here is for those who are far away from Moscow. So I think if you want to have a political equilibrium there, political and social equilibrium, you cannot put all the eggs in the defense basket only. I think this is clearly an essential component, but you are not going to have the support of the population if you put all the eggs in that basket there. So we have to do these other things as well.
Good. No additional question, please.
This works. I want to make a remark more than a question. So I think that, like, we have been talking like all morning about defense, about spending, and I think that so far Europe has invested in peace. Like, we united to avoid wars, and we created more democracy. Like, we might had in the past, like, you know, oligarchies taking place or autarchic regimes in Europe. Now, with the fact that we are all Europeans, this danger is not there anymore. So maybe we lost some of our competitiveness. Maybe we are not as competitive as we used to be because, like, you know, we have the easy customers. Germany is going to sell Mercedes to the Greeks and to the Spaniards, and that they're getting richer because they are united to Europe, etc. And now we come with this new challenge that comes from outside. And I believe that what we need to do is that we need to unite and try to become stronger out of this. And I think that whether defense spending is going to be beneficial or not will depend on how we're going to use it. So I think it is very important to realize that maybe we grow less, but we are in peace regime and we are democratic in most Europe, and we have the ground to make government investment in productive goods, whether R&D, this is it, or it is you know, other common goods, work. And probably that's the moment, like, because we can take the best out of what we have in Europe.
Okay. Stefan?
Thank you very much. Just to bring one little piece of good news, the contrary, I think, Madam Boone, to what you have said, I think, I'm from the ECB Legal Services, sorry. I think that the treaties, as they are, offer sufficient legal basis for all the developments that you have covered in the panel, including as well for agreements with the UK and Norway, etc. Like, I think that we have much more European defense policy than we usually think. And certainly we have the legal basis. We just need to activate them. But we even have instruments on European defense policy which are based on the Treaty on the Functioning of the European Union, not on the TU, but on the TFU. We have it there. It's just a question of making it grow if that's the will of the Europeans. So that's my little piece of good news, that the legal instruments only need to be developed because the treaty offers this possibility.
Thank you. Stefan, and then we go back to the panel, please.
Wanted to make a short remark whether the focus on defense spending is perhaps not a bit too narrow in this context. I'm referring here to this recent article in the Financial Times that you may have read, that it would take like 45 days to move troops from France to the Russian border, and that is of course worrying. Yeah, it can also be seen as reassuring because conversely it would mean it takes 45 days for Russian troops to arrive in France. But the point is here that this has to do basically with infrastructure. It's crumbling roads, crumbling bridges, not only here in Germany, but more broader. It has to do with different railway tracks. It has to do with tunnels that are not large enough. So my point is we would already go some way if we
if there would be a premium in the financing of infrastructure investment to make infrastructure more European compatible. If there were in the next MFF or whatever there is in terms of NGU follow-up, let's say a premium for compatibility of infrastructure and improvement of basic infrastructure in Europe.
Thank you, Stefan. So, Moritz.
I have a very quick answer to that, which is there's nothing wrong with infrastructure, but it's a much simpler solution. Put the troops to Poland, to the eastern border of Europe. What are Netherlands troops protecting in Amsterdam? What are Portuguese troops protecting in Lisbon? So if we were a country, we would obviously have our resources where the threat is. Instead, we actually, I mean, this is you have to think this through. It's kind of absurd. We're actually relying on the Americans, and since the Americans, because only the Americans have that capacity to bring European troops from Portugal to Poland in the case of aggression. So there's a very simple solution to that. It's like Europe comes together and puts its troops where the threat comes from.
It's already happening.
But it's very small with the German brigade in Lithuania.
And on all the eastern flank.
It's very, but I mean, the absurdity of the situation is where we now thinking we need the Americans to bring European troops from one part of Europe to the other is quite mind-boggling.
Okay. No anyone else wants to contribute to this? I guess. So we are 1 minute left, so let me take this minute to thank our panelists for the rich discussion. It was very interesting. I learned a lot. I hope you enjoyed the panel as much as I did. And join me to give a round of applause to our panelists.